Well, I think one of the biggest challenges that we talked a lot about on the panel is this lack of liquidity for institutional investors in the marketplace. Although they're still facing liquidity pressures and they're as underweight as they've ever been in public markets, they're finding new, unique ways to raise liquidity and capital to allocate to private markets. I think we'll probably see consolidation in the industry going forward, which might make it more challenging on smaller managers to compete in that space. However, things change, financing structures change, and there's always creative things happening in the financial markets to sort of cross those bridges. But I think that's definitely a concern. How do you manage liquidity and continue on your asset allocation pace? A lot of questions I get are about the amount of capital raised in private credit, for example, and has that been overextended? And the answer is no. I think if you just look also at the equity and bond markets, we often forget how much larger the public fixed income markets are and the credit markets are relative to public equities. And there remains a great deal of opportunity in private credit. And I think that while we see, the IPO markets continue to struggle and exit struggle there will be different kinds of financial structures going forward. So it doesn't mean deals won't get done. It'll mean that the makeup of these deals look different. And that's where I think private credit can play a really big role in the years to come. Sure. So I think we're likely to see some consolidation, maybe not just on the GP side, maybe even on the LP side. We've seen that happen in, ex-US countries already. We've seen it happen in Australia. So I think we're going to see consolidation in a way to get more leverage on fees and get more leverage with managers. I'm hoping that we'll see a transition from asset class diversification to geographic diversification and other sorts of diversification in portfolios. Because I think one thing that's been really important to remember about these last couple years is that 20 years we saw in negative, bond equity correlations, we're actually reverting back to normal or the average where these correlations are positive. So portfolios aren't completely changing, they're just reverting to a mean that I think we forgot was the mean.